What's up, friends? Welcome to the live stream. Let's go, let's go, let's go. Guys, what's up? Oh, we have a full day today. Oh my gosh. CPI, FOMC. Big deal. Today, Wall Street on the brink of behaving like we're going to get rate cuts. Is this the first time we're going to get them since the big recession? 2/3 of Wall Street today are betting on the CME's Fed Watch. Roughly 2/3. To the majority that we are getting 50 basis point cuts. 50 basis points cut from the rate. Talking 4 3/4 to 5 target rate. And pricing it in, aggressively bullish market. CPI comes in year over year, a very cool 2.5%. Not the Fed's target, but you remember the Jackson Hole conference. Big Daddy, Big Papa Powell himself said that that doesn't really matter as much anymore. They're not likely going to wait for that. They might act beforehand, and that's why right now it's such a humongous change. The CPI is a very big change year over year. It's getting very close to the target that we want to see. And it's very likely that they're going to be doing these things. Now let's pull up some of the information. Matter. More things. These are the things that matter. Is there a Zoom call? Yeah, there's a Zoom call. There should be one. Good morning, fellow victorious warriors. Y'all ready to kill it today? Big event comes in. $1,300 my time, right at 1 o'clock. We'll do live coverage of that. Rate cuts are imminent, according to Wall Street. I'm on the fence, believing that that's going to happen. Now, again, with such a decent read on this data, that CPI that's kind of been holding the fort for a little bit has been kind of in just nosedive since April of this year. Okay, this is great. Great. Can't argue with that. So because of that, Wall Street's overly optimistic. Some of the necessary data to support this, the jobs market. Jobs are continuously lowering. However, we're not seeing a dip in the continuing jobless claims to go with that. So companies are kind of like stalling out on their hiring. You're not seeing a bunch of layoffs. This is pretty normal. So this is first week jobless claim report. Usually file unemployment whenever you get laid off, and this thing is sort of just noisy in the range. 200,000 is pretty normal over a good bull market. Underneath 2 million is also normal in a good bull market. It is not coming down. It is just kind of normal. Okay, so you'd like to see it come down while this is coming down, but you know, it's still okay. So companies are not necessarily filling jobs as much as they're eliminating them with that piece of data. Since, you know, July, we're not seeing the continuous come down. continue to sustain flat. Hey, July of 2022. You can see it's sort of just flat. So it's kind of like inflation's still a problem. Inflation hurts the hiring sprees. Makes it harder to hire people when people want to hire salary and you want to pay them, yada, yada, yada. But JOLTS coming down is always a sign of either a massive growth on hiring spree, which you're not seeing, but also slowdown. And we've been seeing a slowdown because of inflation, right? So this is the one reason Powell was halting on cutting rates. So you want to see the jobs market kind of heal itself. You want to see unemployment come down. Don't want to hit a period of stagflation where people are unemployed, can't get jobs because of inflation. Then they cut rates too quick, and all of a sudden we hit stagflation, which is worse than a recession. But either way, we'll see. The housing numbers come out this morning. The new building permits, a little bit of a beat, actually a bigger beat. The housing market's starting to grow. Interest rates and mortgages are coming down. You're out there looking for a house, you will know that. I'm out there looking for a house right now. Bias FOMC prediction, no cut. That's my prediction. Now, Wall Street's betting on a cut. The necessity of it is, if it doesn't cut, now again, 25 is pretty standard for a cut. And I hate to say that I'll be wrong if I say no cut. That would be like the, I guess that's me being a little aggressive with believing that the Fed is going to hold off a little bit longer. But maybe Jay Powell just wants to appease the stock market so that people don't overreact and delay the process. So maybe just to like give the public what they want. We might get a mercy cut of 25. I don't think we're going to get 50. I don't think that the Fed's going to turn on the spigot for an aggressive rate cut. Not there yet. It's too soon. The jobs data doesn't support it. It would be silly for them to go too quick. We need to, employment needs to be stable first. And for friends, don't forget, those of you guys in Zoom, if you can do me a favor, can y'all go to YouTube? Even if you're on Zoom, can you go to YouTube and leave it open? So that, and then give it a like, just for us, even though you're here on Zoom in real time. By the way, Zoom is in real time. We have a Zoom call that's live that we do every morning with our team. The YouTube has roughly 20, 30 seconds delay on it. So if you guys want to do live, we have a Zoom call you can join. There is a Zoom today. You can see it. I posted the link. I thought I did. Oh, oops. Morning, good morning, good morning. It's not always going to be the same, but it's always been the same lately. We're going to rotate that Zoom link around a little bit. Let's get our DD bands up here. Oh, wait, market's open. Oh, shoot. Okay, hold on one second. I'm not even paying attention here. Market is open, you guys. Oh my goodness. All right, let's draw our DD bands. Now, okay, it's not really necessary right now because we're kind of like in the middle. But there are dynamics on here. Here I am talking too much. All right, S&P futures today, we're going to be sitting here at 95.85. Down here, the 634. Big expected range today. All right, liquidity maps. Let's go really quick. Oh, ooh, come on, bull zone bottom. With hedge break. Wait a minute, what's going on here? Bull zone bottom already? Argue with that. That's just a quickie little dip and rip right there, like right at the open. All right, bulls on bottom. Usually try to take that. Took that with the medium-sized position. Here, back to there. Resilience number is negative, so this is resistance right out the door. That's my trade for today. Bulls on bottom, dip to there. I grabbed some options yesterday at the close. They're up about 40%. Resilience is there on SPY. Resistance is there on SPY in the middle, half cap. BSU. Okay, so BSU is from bull zone, the halfway point right there. Bounce there to there. A decent little trade on that. Let's kind of make sure we get that on center. Okay, let me do some PDD really quick. Okay, where did I put those lines at? Right, so we have DD bands today, 57.38 right here at the top. Tapped it right, kind of like right in the overnight session, and then 56.63, which is all the way down here. And I'm sorry, we haven't tapped it yet. Sorry, no, we haven't tapped it yet. We're good. MHP is always a reversal target. I like to make sure I trade off of that. I think that the market aggressively was trying to sell off yesterday because what I feel like is that Wall Street has priced in a possible 50 basis point rate cut, and then that maybe when you see the market aggressively try to sell before the FOMC, it's like some kind of information is kind of out there. right? That people are probably not going to get what they want. So they're pre-selling into that. So I think that I don't think the market's going to crash out or sell really hard today. No bell glaring for Thinkorswim. The ding, 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 ding. Yeah. All right. So the S&P, I'm looking for support down in here. QQQ, let's look at the same thing. So, interestingly enough, this is kind of an interesting setup. So today, there is resistance right off a hedge pressure. That's the problem. There's resistance there. Resilience is negative, so the market's trying to do this. ED ratio is positive, so the market's going to want to do this. There's all kind of ranges inside of here. This is really strong support. This is really strong resistance. Let's see, 1920. Monthly expiration on Friday. Let's see, 475 today. 60% IV and options. Don't be buying options today. Into Fed and through Fed with IV like this. Yesterday, the IV roughly on these near-term options for expiring today was close to 30. High 30s. Since we have obviously possible volatility in the Fed, options are highly inflated. S&P bull zone, we love doing that. Breaking MHP today, I don't think it's going to be possible, but we'll see what we get to. I always bet on reversals there. Give me a second, guys. I'm gonna have to. They're back. I gotta log into Thinkorswim. I forgot to do that. Options will close up 40%. Yeah, options that expired today. So the option, you don't want to normally buy options through an event that have a high IV because after the event happens, it will collapse the value of your options. If you don't break through the expected range. So I can get a log on my stuff. So essentially the way IV works, the implied volatility is part of the price. The price will already be inflated right now, unnaturally high, relative to what typically a 0-day option would be valued on a day that there's not expected to be a big event. So like right now at the money options are roughly $4 a pop, and that's really high compared to what they normally would be on any other day, because they baked in a little bit of that extra volatility there. So what I mean is you can day trade a 0-day, but you definitely 100% don't want to hold a 0-day option through the Fed meeting. Because what happens is once the event is realized and it's not a shocker that breaks the range, your IV will crush and you lose a lot of your value of your option. So Russell today is pretty much the stronger of the two. Nasdaq's kind of the weaker of the two. I do like the way QQQ is looking. The bands aren't showing in Rocket Scooter. Yeah, our table needs to be able to allow you to roll over. That's why. They're showing just on the they'll show in the U contract. We just our rollover, our auto rollover is kind of broken. So we have a new triple B today. Let's talk about that really quick. My long trade is taken off. Let's run this calc. Shane, you have to go, yeah, the U contract. So the rollover feature on our table is slightly broken. $18.3. Okay. We should delete this old one just to give me some room here. Pivoting overshoots are likely. 18.3. This is for December. Just make this dotted white. Done. A nice little bounce on SPY. That's looking good. 500 up. Oh, yeah, Ethan. Oh, I'm sorry. So what I did was I bought QQQ. So at the dip, at the very close of yesterday, let me show you what I got. Basically, like yesterday, as we were dipping, I loaded up on 474s because the IV was going to go up. So I usually, if we sell off really heavy into the Fed, or we rally really heavy into the Fed, I always reverse. This is one of my tricks. I always reverse it with 0-day options for the next day. Betting that the market's not going to collapse leading up into the event. The market's going to likely do one thing and then do the other. And the IV bakes into the premium. I'm about to sell these options that are at the money for like 30%, 40% gain. So right now I'm letting them move up to my resistance. When I open up with the liquidity map like this, I go, oh, what am I going to do? So I'm at the money right now, but I've got all that IV baked in. Does that make sense? So the idea is that IV inflates the premium. When the market dips really hard, calls are, did I say puts? I said calls. Calls are going to be cheap. Puts are going to be expensive. And so I don't bet on the market reversing leading into Fed. I bet on the market stabilizing leading into Fed. People are selling early. The news is likely going to be good. We're probably going to revert right back to mean. And right at the end of the day, the market went and then instead of closing at the end of the day, I held today so I can get an additional inflated premium for the IV, because the IV spiked up another 30%, which my meager, $3,000 bet is now up like $2,000 or $1,500, something like that. Does that make sense? So I play into the fact that I'm going to buy before when they're cheap and let the IV give me the bonus that I want. So I bought one day out. These are tricks, and you guys join our program. I teach you guys how all that stuff works. So we're going to do options pretty heavily this week. In our training. Did I say no? Did I say December? I'm sorry. Don't listen to me. That's not December. That is October. Thank you. Thank you guys. All right. Sorry, October. Well, right now I'm hoping the bull zone bottom supports to the halfway point. So my trade that I usually do, I'm going to close it out. To the mid. You guys know how that works. resilience less than 0 is going to have a hard time breaking through. That's the problem here. What do I want to do? Rest of the day. Oops, I don't want to do that. Stocks aren't participating, so that's why it's having a hard time bouncing and going pretty far. That half gap is typically resistance. We are in a broadening formation right now. VIX also has a bullish liquidity map, which isn't the best either. So monthly expiring options closer to the 20%. The volatility is expected to, dive out after the Fed decision. What breakout high do I want to bet in case the Fed does rocket the market higher? 461 is the retrace target in case we do. Okay, so these are the levels I'm looking at. So downside move retraces to red line, right? This is that line that we're on. In case the decision comes out, expected. What I think happens is we do maybe, I don't think we're supposed to be getting rate cuts, but if we get like a mercy cut, doesn't make sense to cut rates, but Jay Powell might do it. Market's going to pop, and then it's going to sell. That's what I feel, but then it's going to rally into the month. We know we're not going to break lower lows, right? Typically, the end of the calendar month is going to have a wick at the bottom. I think this is the low we're going to get for a little bit. Monthly maps are looking good too. If there's a shock, the thing is the market's already aggressively pricing in the shock, the 50 basis point. So I don't think any rate cuts are going to break us out to highs, but the press conference will reveal that part. Are we aggressively going to go higher in the next cut? So we'll see. SPY's already trying to crack and break all-time highs again. me look at S&P really quick. Okay. MHP bounce on SPY. Oh yeah. Chilled on that for a little bit. All right, I'll be right back. I'm gonna get me some something to eat really quick. Oh, that's the wrong screen. Be right back. What's up? What's up? Oh, Ethan, I'm sorry. I was talking really fast. Key will be what the pace of cuts will be, as Too Good to Fail is saying. If we don't have a path to 1 full percent by end of the year, the market may not be happy. I 100% agree with that. The market isn't going to be happy unless we get aggressive cuts. So here's a good reversal target here. This is a great support. Monthly res is greater than 0. I don't hate that. Okay. So MRES greater than 0. Supporting there. PD ratio greater than half. Support to there. Resilience less than 0, though. Which is the white line. This over here. MRES and RS. So that's resistance. You can see how it all played out today, right? This white line's above 0, then that wants to go there. They're waiting on this guy. Friends on YouTube, don't forget to smash the like button. We're here all your Fed coverage. Trust me. It's going to be an interesting day today. My thought is, and I have a unique bet opportunity that I want to do. I might want to smash some very low, like I'm letting the market dip today so I can stock up when we're cheap today. I'm going to buy some Friday expiring out of the money calls for the breakout range just to break highs from 2 days ago. Highs from yesterday, sorry. Like that 478 top. And then whenever I do enter that position, I'm also going to buy 1 week out retracement low puts. Slightly expensive, and just hold them for 1 day in case the burp goes against me. So this is, let me show you guys what I'm going to do. The way I'm going to play this, I'm going to do next day expiring options for here, calls on Q. As soon as we hit like low monthly res today, I'm going to buy this just for in case we burp up. Now, again, I'm not looking for this to rally and go. I'm looking for this to burp up, and I think the market's going to sell. So because of that, what I'm going to do is I'm going to spend a little bit more money and get 1 week out 461s. Very far out of the money. Very cheap puts. Just in case it pops and then starts to sell. And again, I'm going to sell both of those by tomorrow or by the end of the day today. The reason I get these really far out, because in case the market collapses, it's going to collapse. I'll make a whole lot of money on that. The market just kind of jolts around in here. I'm going to sell each leg as they go in the money. The theta on the week out is going to burn less in case I'm completely wrong. Like the market just rallies up. I'm not going to lose much. They're dirt cheap. Ideally, what I want the market to do is pop and drop. So if the market pops and keeps going, then tomorrow I close these out, and then today I cash these guys out. I post these in the room? Yeah. I'll talk about them today. If you guys are in the Zoom call, I'll detail my options trades today. Does that make sense? Let me kind of like figure that out really quick. All right, let me start over and preach on it again. But I firmly believe, as Too Good to Fail has been mentioning in chat, is that the market will not be happy if we don't get the aggressiveness that it's pricing in. If we don't get commitment to 1 basis point cut or great, I think greater, but yeah, at least that till the end of the year, Wall Street will not be happy. We are pricing in 50 basis points today. If we're not getting 50 basis points, the market will not be happy. If we don't get a rate cut, the market will not be happy. And that is very aggressive to go from no cuts to 0.5 point. An inflation target still isn't met. Now, despite what he said at Jackson Hole, that, well, we may not wait for that. What he said, okay. So Wall Street is being aggressive on the idea that the CPI numbers are awesome. Okay. Makes a lot of sense. So any expected news like 25 or 50, I don't think breaks to new highs. Okay. But also, I don't think the month closes any lower than this. So the idea is I want to span, I don't want to buy options today at 50, 60% IV. I'm going to grab ones for tomorrow that's roughly at 30% IV. So they're not as expensive. All I want to do is see the FOMC challenge highs by tomorrow in case the news is all right. I don't expect the news to break here and keep going because 50 basis point is very unlikely, and that's already the expected thing. So who would bet on a breakout from that? Amateur traders. The expectation is 25% cut, but futures are pricing in 25 to 50. So be careful. Understanding the market has become overly optimistic about even a bigger cut than that. The CME Fed Watch, as you see, target rate probabilities, 61% of a 50 basis point cut. That's even bigger than the 25. As feedback is saying in the Zoom call, I 100% agree. 50 basis cut expectation at all-time high leaves no real room for an upside move. I love it. See, I talked to my girlfriend yesterday. I was like, there's three kinds of traders. There's your amateur trader that hears, oh, the Fed cut rates. Let me get in on this. Okay. The advanced trader is going to say, aha, newbies are going to think Fed cut rates. Let me get on this. So when they get in on this, that's when I should sell. Let me get on this earlier. Let me bet that the Fed's going to do that. And then let me get in on this earlier. And then I'll sell when they're buying and make my profit. So the master trader, so while the advanced trader is, let me one up the newbies, the master trader, let me one up the advanced. So the advanced people bought last couple days, are expecting the newbies to buy on the expected news and the market to pop. And the newbies think it's going to pop, keep going, as the advanced traders in our room are saying there's very little room for upside move because the expectation is pricing in 50, which is the unlikely thing already. So the market, as we've all identified in our Zoom call, is likely to be disappointed. Do we all agree? Wall Street's likely to be disappointed in whatever happens today. You guys got it? This is the advanced trader mindset. To understand the expectations. There's no room for an upside move. And we have to hit the rarer case expectation just to appease what's already priced in. The master trader understands the efficient market hypothesis is that all possible things that could be known are priced in. You always assume inside information is there. And so if the inside information is there, why do we have 2 days of people taking profits below all-time highs leading into FOMC? Because the master trader expects the market to be disappointed leading into Fed, which means it's going to pop and it's going to drop. The master trader is one step ahead of the advanced trader. Cheers. HEB sparkling water, baby. Who would be fucking selling leading into rate cuts? People that either have the inside information or understand what you guys all just said in the Zoom call. The market will likely be disappointed. So let me capture some very cheap 1 day out, 30% IV. Just test the high calls. And I don't even care if it gets there. We just bump and I'm selling. I'm going to get calls right here at 478. But then a week out, I'm going to get some very cheap 461 puts. And I don't even care if we get there. I got a week for this to pop and drop. And either way, if it pops and keeps rallying, hello, free money. Yeah, this will lose just a little bit. They were cheap already as it is. Okay. If the market spans just this range, it doesn't matter which one, it's first. I'm going to sell at either extreme and make money on both. You guys like my trade? Why a week out on the puts? Because I feel like Wall Street's going to be disappointed no matter what we get. And unless Powell comes in at that press conference and starts saying, we're probably going to cut rates again next time too. Wall Street is not going to be happy. Now, I don't think the market's going to collapse on this news. I don't think we're going to get here. But I don't think we're going to pop and rally. But I can turn both calls here and puts here Let's look at the scenarios. The market this is in the expected range. If the market just outright collapses, and these ultra cheap 1 day out of the money calls just probably lose all their value. If I put $2,000 into that, I'll lose $2,000. If I put $2,000 into that, I would likely gain that $2,000 if it just falls straight down. If it falls straight down, it's likely to keep falling. That's the problem. So my expectations are if it falls to here, I'm just going to hold on to those puts and hold on to those calls. These puts are to hedge that position. And I got a day or two to have some premium in that tomorrow in case the market does rally up. There's still some value in that. I could just dump it. Like if the market rallies up and I make a shit ton on this and I still have an investment there, I could continue to hold that as a hedge against further long bets for the next week. So the idea is my short side of the market. And I was thinking about doing spreads to sell options as well, to pay for it, to fuel into it, to bet that we don't break out. So I could like buy calls at the high and then maybe sell calls at 480. So a good credit spread would be to sell calls outside the breakout range to bet that it doesn't break out. Yeah, to buy puts 1 week out, no calls is what I want to do. So as soon as the market pops up today, if it does, I'm going to have these in my pocket. Let's look a week out. Let's get them. I'm going to get them all set up to do this. If you want my fullest opinion, I don't think that we're going to sell off. I honestly think that while Wall Street will be disappointed, there's still enough bulls there. I don't think that we do. I don't know. I don't think we break the range today. This is my expectation. I really don't feel like we do. But do we like 30 minutes after or before the news to look for a trade? On the on scalping side, yeah, I do. I usually wait for the 15 to 30 minute window right before the press conference to aim for or to look at my positions I want to do. And then during the event, when it taps any one of my pivots, I usually play off of those. The problem is that with like we're sitting, what I like to do is take like the expected range that we're in right now. This is the expected range. Like you get your hedge pressures here and here, right? This is your breakout high. This is your breakout low. And so inside of here, I like to leg into both sides. So like if this hits low right here is when the calls will be the cheapest. I'll grab my calls. If this were to go here today, then the puts would be the cheapest. I'll grab the puts. Somebody said they're buying puts, wish them luck. I think that days like this, the master trader will have to understand that the market's going to pop briefly and then probably sell. No matter what. On the news. But then when Jay Powell starts talking, if he just hints at further rate cuts, the market's going to rally. So if we can get a commitment to at least 1 basis point by the end of the year, Like he says, today's change in policy, marks a permanent change and Fed's monetary policy so that we can, we're starting to see inflation change. We're happy with what we see, and we're not against cutting rates again by the end of the year, and market's going to go fly straight up. So in reality, all eyes need to be on the press conference today. If we do get any kind of cut, the question is, what's the second cut we're going to get? Okay, ooh, here we go. There's my lower end trade here. MHP break on S&P. What? Oh, okay. Here we go. Let me leg in. Let's get some longs here. Okay, got my dip, got my longs. 478 calls, grabbed them on spot on QQQ. Very simple. Not betting on a breakout, just betting on going towards highs. I get them right at Delta 40, Delta 50. I'll dump those guys. Any movement today up here, I'll get my puts a week out. And again, like I'm just gonna buy dirt cheap, way out of the money puts, and then all they're gonna do is just hedge my long bet. If the market sells because it's unhappy with the press conference, it's gonna sell hard. I don't think it's going to be unhappy at the press conference, and I don't think we're going to rally off of today's news. That's the example. That's what I think. All right, let's take a poll. What do you guys think in chat? Let's hear what the community here thinks. What do you guys think? It's all the pieces. The market wants to be there. Now, again, FOMC is not going to care about structure at all. These are your breakout ranges today. This is quite simple to see. Okay. Breaking either of these are your breakouts. The fact that they're very close to each other means the market is wound up tight. Okay. This wants to happen because DD is greater than 0. Resilience is almost above 0, so that's good. Like I said, it's just kind of like a nice little clean setup today. Nothing's going to happen leading into Fed. I don't think the market's not going to sell. Market's going to rally. Market's just kind of... So when you lead into FOMC, you have 3 different waves. You talked about this yesterday. How to trade the FOMC, okay? You have 3 waves. 1, 2, 3. You have the initial reaction, which is like 0 to 5 minutes in. Initial reaction. That's on the news itself. That's did it shock Wall Street's expectations? Today, the only shock is going to be that we don't get a rate cut. We're going to likely get a rate cut according to what Wall Street's pricing, and if we don't get it, that's a shock. So unless there's a shock, the first 5 minutes realizes that we priced in and we got it right. Likely we're going to realize we priced in and got it right if there's a cut. If we don't, then the first 5 minutes is going to sell off. The next is like up to the press conference, 5 to 30, and then 30 plus. The press conference is always 30 minutes after the announcement to give market some time to digest the news. Because like Fed Day is like back-to-back news. It's like, here's the rate cut and then here's the next rate cut. It's like 1-2. So you're going to get like a little split here. This is now, and this is next month. Okay. So after the initial reaction spans the market and doesn't shock, then you have the people pre-positioning for press conference. That's part 2. So what's really interesting about number 2 and 3 is that they're pricing in next. Okay. Pretty rarely is number 2 unless there's an upset, and there's very rarely an upset. Market usually knows what's going to happen. So between the event announcement and the press conference, Wall Street's usually positioning to bet on the press conference. Remember, Wall Street's always trying to bet ahead based on available information. The available information is that the press conference is all that all the hints that we have for next time. So if the 5 minutes dips or rips on the initial event, people are already positioning for what they think the press conference is going to be based on the data we have now. Somebody will say, okay, if we get the rate cut, then we're likely going to get another one. If we don't get the rate cut, we might get one next time. And people in the 5 to 30 minute window are betting on what Powell's going to say to position for the next month to get a month ahead. So 2 is kind of like, it has still some residual in case 1 is an absolute shocker, then 2 will continue that shocker. If 1 is a dud, then 2 is positioning for 3, and 3 is the big move. So usually you'll see is like the FOMC does a little bit of nothing in the first 5 minutes. It kind of returns to where it started. And then it starts to kind of like move, and then it might get a little wider. You never know in the next 30. And then the press conference is when it really starts to just nuke shit. Does that make sense? So don't really put too much faith in what you see on the surface. Understand that people are going to be positioning for the press conference. The real catalyst is number 3. 30 minutes out. Okay. Remember, amateur trader is going to bet on what is. The advanced trader is going to bet ahead. The really advanced trader is going to bet ahead of who was already betting ahead. Y'all think we get 25? I think we get 25. Like I said, this is all right, let's go here really quick. Today's today's pre-FOMC selling again is expectations of the market is certainly looking to be disappointed. We've optimistically overpriced in aggressive rate cuts, and I don't think we're gonna get them now, but we might get them over the course of the year. So we're gonna wait to see what Jay Powell says. I'm leading into that. Wait, where was my QQQ? Hold on. What was that level I was looking for? 461 is that retrace target. You agree? 25 basis market sells off. Yeah, it pops and then sells off. So I'm gonna use today's high to get my cheap puts for next week. But I don't buy them for 0 day though, because I don't want to pay when IV is like 70%. The thing about buying yesterday is that any near the money puts while they're losing some theta, the IV keeps them artificially inflated even though I'm out of money. That's a little trick. If you know the next day you're gonna get a 30-40% bump in IV, then and you know it's gonna be a range day, your options will gain a lot of value to offset any loss in delta based on the IV. So like, you know, don't buy on the day of earnings, buy like a couple days before if you're betting on something happening. Somebody who's at the dentist, gotta take care of your gums. Nothing really happening today, just a bunch of chop. So friends in YouTube, don't forget, we have a massive community of over 6,000 members, paid members. Check us out. I don't know why the chat bot's not working, but here is some information. You guys want to join our Zoom call? We'll be live on Zoom later on this afternoon. It's only $1 a day. Access to the tools. A 1-month trial on the website. Check this out over here. Ooh, we hit 40 reviews. Thank you guys for leaving a bunch of reviews. I told y'all to leave honest reviews, by the way. I didn't tell any. I told you guys I'm always about honesty. So here is the 1-month trial of our tools, the whole platform, everything. Right now, the majority of our members are in our Zoom call that we do every morning. It's live in real time. Our full training goes over the probabilities of each of these setups from historical back tests. Today, under most conditions, 60% chance we close above 474. Now again, events the probabilities don't count for events. Structure being normal, 60% chance a break of here returns to there. Just like yesterday, same setup. Under more ideal conditions, bull markets, no catalyst, no events. All these lights are like here. All these lights are green. Bull market, DD's in agreement. That sometimes could be, in certain bull markets or bull waves, could be upwards of 90%. Somewhere in there. So under the worst conditions, about a 60% chance you don't lose bull zone and keep going to bear zone. Keep that in mind. So the bet is down in here. We're likely to be up in here. See how the market's trying to make its way back to there. This is what's called the bull zone. Oh, you can't even see on my chart. Here we go. Hold on. Wait. There it is. Without an event, it's rare to break MHP. I always reverse it. Every time. From the bottom, I reverse it. From the top, I reverse it. I always bet that we reverse MHP. Every time. At least with a small position, no matter what. This yellow line is a tiebreaker for here as well to give me a little extra information. Tell me if I think it's going to break or not. Tell me my position size. If the yellow line resilience disagrees with me, I'll trade smaller on a long. I won't trade on a short. So I need the confluence here. Right now, the confluence is this is positive. This is not negative. It's in the middle. So yellow is likely to hold, which is why all day in these dips is when I was buying my out of the money calls. As you see, I have no fear of the market selling off today. Bull zone is likely. I've just been scalping this. Having some fun with it. Goes a little bit that long. So basically I bought again, trimmed out a little bit at the bull zone kiss. This is a scalp all day long from here to here across the thing. If SPY resilience is negative, then half gap is my target. Top of the box is target. For bear zone, the bull zone is always a good target, at least on the scalps. I'll close this out. First move here, boom, close it out. Okay. So scalp that from here to here, here to here. I'll play this game all day long. That was a good long. As I'm sitting here, 60-90% chance you return to bull zone. Can't complain about that. My 470s are max delta. Let me go ahead and close our channel. Sell maybe half. So the ones I bought from yesterday. Okay, good. So the options I bought yesterday, now that we're back to the money, I sold for about a 22% gain. They were just 474 Qs right when we tapped it. Like, I thought about selling at the open, and when it fell, I just held. And then now that we're back to there, I just closed out. The IV alone was a trade. I was betting on a flat market. Retracing. So that was an awesome trade. Again, this is a little complex option setup. And today, I'll talk about option setups in today's class. So the Zoom call we're going to do in the afternoon, I want you guys all to come to that. Like I said, it's $1 a day. If you're just tuning into the YouTube, join our webinar series. Go to that link I put. It's called 20 Days Probability Mindset. It's all about the statistics of the market. Did you know? I will give you some tidbits from that class so that you think that it is worth your time. You will learn more, I promise. I will tell everybody, I'll give you your 20 bucks back if you don't like it. You will learn more in that first class than you have in 5 years of you learning the market. Your brain will be like, whoa, wait a minute. The first video itself is a shocker. Let me give you one important piece of information. Okay. It's called 20 Days Probability Mindset. And the first thing that we say in that class, it's all math and statistics. As you guys know, I'm an engineer. My background. The degree right there. Right there. Wherever I'm pointing. I don't even know how to... I could never be a fucking weatherman. There it is. All right. Did you know that in all markets, doesn't matter, bull or bear markets, doesn't matter. Doesn't matter. Doesn't matter. On the index, I don't care if it's the worst recession you've ever had or COVID or whatever, that in any particular market that sells off, there are just as many green candles as there are red. 1-to-1 ratio. Every up day has a down, every down day has an up. And it only is a small period where the market's actually crashing. That's a weekly candle. We get a daily candle. Okay. So we do the statistics of this stuff. You know, we go all the way back to 1937. Come on now. Spend your time and count it. We start off doing this. Now, what we say is 20 days probability mindset states as follows. I proved statistically, and we talk about it in this course, and I use the monkeys typing on a typewriter can ultimately produce Shakespeare, that random Brownian motion argument experiment. So I do the same thing here. I say a blind monkey can throw a dart at the dartboard, which has the word L written on the dart, which means long the market somewhere and pick a random day and time and just long every single day of the market. If the position size is scaled correctly to where after a month, using the statistics of in a down market, there's a red day for every green day. Red day, green day, red day, green day. So with the 50% chance of the day being green, and in a bull market, it's roughly 3 days up, 2 days down. So it's more of like a 60-40 thing. So in all particular cases, longing the market is the stronger choice, even in a sell-off market. Here's the recession in 2008. Tons of green as it fell and only crashed right here, even though the market was doom and gloom. Housing market collapsing, collapsing, collapsing. There is literally more green candles in here than there are red candles during that 2 years of people clamoring about the stock market going to crash. You guys see this? All right, can we start here? Completely blows your mind about understanding what crashes the market. Sure, there may be like these 4 or 5 day crashes in here, and it may be on the trajectory down. But boy, oh boy, there's a lot of green in there. In day trading, longing isn't a terrible idea during this time. As long as you have your stop set and you're out at the right time, the 20 days probability mindset tells you that if you are the blind monkey longing the market randomly at random points in time, at random times of the day, once a day, with risk management designed so that at the end of a month, you don't lose half of your trading account, you will statistically make money by the end of your lifetime because of these other statistics. We give you a whole sheet of statistics. I'm not going to review it here or reveal it here, but over the course of the last 10 years, which includes recessions, 70% of months are green. 30% of months are red. I don't know if you knew that. Calendar months, it's the end of the month, not the trading month, the calendar month. And of those green months, only 20% of them sold a third of the value they gained in the month by the end of the month. What that means is green candles on the month love to stay green and strong with a teeny little wick. Awesome, 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 awesome. They very rarely sell off much of anything. Every once in a while, you'll have one that sells off something. But you guys all see this? Green loves to stay green. 70% of all trading months, only 20% of them will lose a third of their value by the end of the month. Blind Monkey's going to do great. 70% of months. Of the red months, again, only 30% of months are red, but 60% of red months wick 1/3 or more. Even in a red month, the monkey should still buy at the end of the month. Everyone in YouTube, do you see this? Type yes in chat if you see this. Green, don't fade a green month. Always buy the end of a red month. So we start with the framework of this, and we work all the way down into our trading style, and it's all statistics, right? So it's statistical edge and probabilities. It's 20 sessions, 20 webinars, $20. 20 trading days in a month, and it states that if you can have half of your account in a month longing only the market randomly longing, you didn't position yourself to lose more than half of your account based on where your stop loss is, then statistically you will make money over time, because 70% of months are green. Don't sell off at the end of the month. The crypto hamster strategy. But the thing is that's not the trading strategy. That's just the framework of understanding that any solid, reputable trading strategy, unless you're a hedge fund with a lot of money to play with, is a long-only strategy. Okay? And then from here, we talked about the probabilities of things happening. Okay? Now, those are just the starting odds. The entire class is all about the odds of each one of these particular legs on our flow prediction and volume prediction that we do. So, under normal conditions, when you have a bull market, you open in a bull zone and you lose the bull zone, 60% under the worst case conditions, you return. Closer to 90% on the best case conditions, which is like solid bull run months. We've seen bull zone hold 90% of the time in short backtest periods. Over the history of this, a statistician, there's a guy in our member base who's an engineer as well, does all the stats to show us these things. Under all conditions, at least 60% you return to here, which is why this scalp is paid off today. So with the stats I showed you earlier, it's very rarely you're going to see me short the market. I need to short off of something. I will always short off a monthly hedge pressure from the bottom. I will always short off a bear zone from the bottom. You approach this resistance here, I'll always bet that it breaks instead of bet that it fades. Blind monkey. I always reverse monthly hedge pressure, and this is all from the class and how much I usually trade. A normal size position. You saw me with 5 E-mini contracts. That was pretty sizable. It's worth 1,000 something bucks. The idea is we will cover, it's all statistics. The reason you aren't doing well in trading is not because you're not predicting the stock market the right way and you're not using the right indicators or whatever. You're not doing well in trading because you don't know how to bet. And the reason I do well in trading is to know how to bet. Difference between you and me. If you're doing well, it's because you know how to bet. You know how to take risk, how much to take, when confidence is in your favor, or confidence shows your trade is in your favor. You bet heavier. When your confidence is low, you bet lighter. You always know what your risk is, what your loss is, and how much of your account you're going to lose. You always know how much you're willing to lose over the day, over the week, all that stuff. Like, all of the turmoil in my head is never about, oh my God, is the market going to go up or go down? I never even care about that. Turmoil in my head is that I bet correctly. Am I betting too big right here? Am I betting too small right here? Should I trim my position? Those of you in YouTube, do y'all get it? People in Zoom was like pays for itself instantly. Been in RS for a while. And still listening. Knowledge is like a river, especially with the market. It's all about the odds. Like all you have to know is the odds of certain things happening, and all of our setups have statistical probabilities. Things happen. These are flow paths that are predicted by market maker options. You can't predict stock market price action at all, but you know probabilities of which things happen. Market's all jolting around. I'm not really doing much. My 478 breakout calls are up 12% right now. I bought them right when we dipped here on QQQ. Expire tomorrow. As soon as we move up here today, I'll buy my week out breakout puts, the cheap ones. Just I'll put like $1,000 on that trade. So I'll lose 1,000 if I'm wrong. If the market rallies, I'll make a shit ton of money on these near-term expirations. They'll go up 500, 600, 700%. I don't feel like that's going to happen. I feel like on the pop, I'm immediately going to sell them. And I have $1,000 worth of insurance that over time, if the market sells off for 2 or 3 days, then that's going to pay off as well. So right now, on this teeny little pop that we have, I'm gonna position into my other ones. To get out UVXY, MHP. Well, yeah, that's the point, right? On the long side, at least. Or 61 is hyper aggressive, but I want it to sell off for a day and then I close them out. I don't want him to strike in the money. I just want him to gain a chunk of delta. So maybe I can even do 468s. No, because if it's going to 468, it's going to do the whole thing. So let me 461 just to make him cheap. $150. Now it's too expensive. 20th, 461. Buck each. I can put $1,000 on that. These guys will gain 500% if it falls there. By 5 at hedge pressure, which will immediately lock in the percent I've made. Let's hold on with the theta on these guys. 461 September 20th. Let me. Oh wait, that's too soon. September 23rd. 23rd. 1, 2, Wednesday, Thursday. Friday. Get that till Monday, the day after expiration. 470. 61. $1.50 each. IV is 26. That's good. Beta, I'm gonna lose 40 cents a day. It needs me to move 20 points today to offset the theta I'm gonna lose. Can we span 20 points? Or sorry, can we span 2 points on Q? 475, 472. We absolutely can. Okay. So I'm gonna strike here a week out just so I don't lose a lot of theta. They're out of the money. Theta burn's not too crazy. I'm gonna lose 40 cents today on the option if it doesn't strike. Which means for $1,000 I'll lose 400, but I'm already up 400 right now on the calls I bought. So let me neutralize that right now. Market 461 puts by 10. All right, so what I just did, I just now effectively locked in my profit. Down here at the bottom, I got 468, or sorry, 478, sorry. It expired today, tomorrow. And up here, I've got 461. Again, neither of these I expect to strike the money. Expire next Monday. Wednesday. Monday. I spent $1,000 on this trade. Again, I'm not playing with a lot for this one. $1,000 on that trade. The theta is 40 cents. Let me double check that. 40 cents a day. So this will lose $600. Oh, it will lose $400 already on the theta if it doesn't sell today. The ones I bought today already gained $400 on the delta. So essentially, if this keeps rallying, the gain that I get, so basically I neutralized how much I've made with how much I'm going to lose by the end of the day today. How do you get on the new website and register? If you're old lifetime member, old lifetime legacy, you can just log in with your existing email. I didn't buy any 0 days. So, anywhere from here, anywhere in here, I'll be green for the day. The way I've structured this. Come on, clear all drawings. I'll prove that to you. Anywhere in here, my option trades will be green. The net sum by today, before the event. I'll show you a picture so you know I'm not lying. Right, if we have a down tick and a hot second here, I'll take you a picture. I'll show you a picture of it. This is a little bit of an advanced kind of options. See, we just ticked down. They're both green. So I have about 4,500 total in this trade invested. So because I've effectively legged in the short-term calls here and slightly longer puts here, at the dip. So anywhere inside of here, the trades are going to be winning. So I've structured myself now, so I'm green, kind of no matter what happens. If I'm wrong on the long side, I lose $3,000. If I'm right on the short side, I'll probably gain a whole lot more. I don't think the market's going to really surprise anything. I think we're going to pop and drop. Either way, in the 30 minutes leading to the press conference, wherever we are, I'll likely close the advantageous position on the long side. It should be more than the total cost of the puts, which I literally only put, I don't know, $1,500 into that. None of them are too affected by IV. Both of them were purchased closely to about 20% IV. 29%, give or take. No. The 461 was 26. Yeah. The IV was low enough. There's going to be no crush if it doesn't break the range. Oh, I'm excited. Good. We're in a good spot. how come you can't see the screen? What happened to the Zoom call crash? The heck? No, I didn't click it. It just like stopped on its own. Did I size them symmetrical? No, I didn't size them symmetrical. Not for the... Oh, I'm sorry. For the loss potential and the range, they're symmetrical. So I'm hedged either. I'm hedged in all conditions, basically. The reason I put more to the call side simply is because I'm bullish the market. I mean, that just makes all the sense in the world. So the idea is if the market sells, it will sell hard. It's not going to sell easy. It will sell hard. So it only takes a little bit of money. When the severity is high, the bet is small. Remember, I always bet small on the shorts. I never take sizable short bets. Do we understand that so far, Arsh? I'm talking about in the Zoom call here. I never take sizable short bets because if the market sells, it sells really hard. So I take smaller hedges on the short side just to give me some insurance. I almost never take normal shorts unless I'm scalping against bear zone from the top or monthly hedge from the bottom. I'll take bigger shorts, but in reality, I short small-ish as much as I can. Yeah. So it doesn't take a lot. If this market capsizes on NMHP break today, then the $1,000 or $1,500 that I've invested in puts will more than make up the $3,000 I lost on the shorter term call to bet on the breakout. The call isn't even betting on a breakout. The call is betting that we just test highs from yesterday. That's it. So the idea is I've got a medium-sized bet. I mean, it's not even medium. It's just, these are both, it's like small and smaller. Again, I'm betting on volatility is what I'm basically betting on. You guys understand? I'm not betting on a muted response. I've got here by tomorrow. I've got here by next Monday, but it's not going to happen. I'm going to get close to 461. If I go to here or I go to here, first of all, if we go to here, I'm Xing out of the long. I'm taking that profit and running, and I only have $1,500 of insurance that I lost. I will more than make up. I will make $10,000 on the long side if I'm right with a $1,000, $1,500 insurance to go with it. These options will go up 200-300% if we burp the test highs. So in reality, like it's not really a spread. It's more like a. It's not really a spread. It's just because I'm buying puts and I'm buying calls. And there are different expirations. There's not really a name for it. It's a hybrid kind of trade. So like the official term is technically called a straddle. But it's not technically a straddle because I think a straddle requires them to be in the same expiration date. And wait, hold on, wait, not straddle. Sorry, strangle, straddle, one of the two. Straddle is at the same put and call, the same strike. Maybe it's the strangle. I don't do the traditional spread. I leg into it. I don't follow any conventional rules of options. I think it's called the straddle actually, or the strangle. Sorry. Let me see if I remember I had it right. Maybe I got it wrong. And a strangle requires it to be the same expiration as well. So like it's a hybrid because it's not the same expiration. It's a mix of a calendar. It's like It's more like a diagonal spread without the sell side of the options to pay for the options I bought. There's really no particular spread for it. Like the traditional option strategies, a straddle requires you to buy a put and call at the same strike, same expiration. It's more akin to that, but I'm buying different strikes and different expirations. Yeah, so this really doesn't qualify as any traditional spread. Hybrid strategy. At the dip, I bought calls. At the pop, I bought puts. I bought calls when they're cheap, bought puts when they're cheap. And whatever the market does, I'm betting on some volatility. Whether we break out the range or not, I'm pretty solid. I'm more bullish the market than anything, which is why I'm in a 2-to-1 bull to bear trade. If the market becomes bearish in a bull market, it's going to sell so hard that my tiny little insurance will definitely pay out from losing anything. In reality, this bet will only lose. There's only one way it's going to lose. Is if the market does this over the course of the week and I don't liquidate one of those positions, then they're both going to lose. So the idea is that if we pop to test highs, I can take this profit. It'll be much more than the loss I took. I'll gain roughly about 10K of profit at a cost of $1,500 insurance on the downside. And I will sell this, immediately sell. And I'll just hold on to this in case it does sell off. And every moment it sells off, this is also going up in value, negating some of that $1,500 loss. So I've set myself up for the pop and drop case or the pop and rally case. The market pops and goes, baby, I'm in the money. Okay. The market just completely collapses. It needs to collapse enough where I make enough to offset my $300,000 or 30 whatever $3,000 long. So if the market sells hard enough to neutralize the trade, whereas this is lost as much as this is gained, I can sell both of them at any time for less profit. So essentially the cases are, if the market just collapses, I'm going to make less profit. If the market rallies more, I'm going to win this trade no matter what. Only be a dummy if the market goes absolutely nowhere, and then I'm going to lose on both of them slightly. I can close both of them out if the market doesn't move within the hour. And then both of them might lose, I don't know, $200, $300, $400 each. So I might lose a total of like $800 for the potential to make 10,000 if I'm right, and the potential to maybe make three grand if I'm wrong. If the puts go up 300% and the calls lose 3,000, then I will likely make 2 grand. So in reality, if there's any sort of volatility, I'm going to make money. If the market does absolutely nothing through those 30 minutes, then I'll probably take a small bite on both of them and a little tiny loss. So your loss in this particular scenario comes from the fact the market goes nowhere. The calls and puts both bleed out. But that's why I pushed the puts out farther, so that the theta is only $400 a day. So if the market stays flat, my puts will lose that theta. So I'm going to lose $400 if the market goes nowhere. And then the theta loss on tomorrow's calls is going to be and this stuff I'll teach you guys how to do in the courses. $180 per 100. So this is 400 on 10. Okay, so this will lose $400 on the 1,600, whatever the value is, $1,600. This is going to lose 180 times 2.5 because I'm in 25. That's 450 on the 30,000, whatever I've invested. 3,000, sorry. So if the market goes absolutely nowhere today, like meaning that it's just flat and muted, I'll probably lose 600 bucks. And if I close both of them out by the end of the day. You know what I'm saying? Market just goes nowhere. But if it pops, I can always sell one leg. If it drops, I can always sell one leg. So the real loss is the market goes nowhere. I expect volatility. Okay. Does this make... It's like a two-leg. Would I plan to teach options and spreads? I'm going to give people one more week to sign up, actually, for the Zoom call stuff. Sign up for the new package. By the way, guys, sign up. We'll cover all of this. Look. I told you. Look. I'm up $5. Market's selling off and I'm up $5. The picture from earlier, when the market's up here, I was winning both of them. Down here, the puts are starting to take over and make a little bit more. So essentially, like I said, the market, if it hugs this range, even if I get lucky and I sell the calls there and sell the puts there, they're both going to make money. If the market breaks out one way or the other, it's going to break out fast. So I get plenty of options to decide. And again, if the market just, I don't do anything and we're muted inside of here, I'm probably going to lose $1,000 if I dump both of them by the end of the day. So that's the whole point. But you can't just buy them at the same time. Down here, I bought the calls. Up here, I bought the puts. And now I'm just losing theta. Every minute doesn't move. Okay. I'm betting on volatility. 60%, 70% implied volatility at the money calls for today expiration. Or at the money options. So call and put will have the same IV. There's a book called Parity, but you know what I'm saying. IV is high on both of them. If we break out of the range, if we break out of the range, I will make money both ways. It doesn't matter which way we go. Because the breakout will be massive to the downside, and the breakout will be sizable enough to the upside that the shorter term calls will make 400%. I'm only betting on this because it's going to be a blowout Fed. I mean, the market's going to be very disappointed with what the Fed says. Will likely pop and drop. I'd want to sell those calls if they get anywhere near the money. I'm going to dump them. The trade's going to win. For those of you, I'll be streaming on Zoom. Come to the Zoom call later, and I'll walk you through my trade as it's happening. So anything above bull zone today, anything above bull zone today, anything above bull zone today, and both of my trades will be green. Watch this. Ready? Ready? Hold on. Let me take a picture. Let me take a picture. Or sorry, my trade will be green. As long as we all bull zone today, my trade will be green. Which will likely happen. DD greater than 90. So anywhere inside of here, the calls will gain more than the puts. 60% chance that happens. And this is why we do what we do here. I teach you how to bet. That's the way you want to sit at home in your underwear like me and trade for a living is you have to know how to bet. You're not trying to pick the direction of the stock market. You're just trying to learn how to bet. How to bet. That's it. Nobody can predict the direction of the stock market. Oh God, the stock market is nothing but random collisions and Brownian motion. It's like drop of food coloring in water. It's just like dispersing randomly. The buying and selling is random. 100% random. As a matter of fact, you can't predict a single thing. Goodness gracious, nothing. This is my sizing asymmetrical, and your delta is higher on your calls. That's why you're winning more as we're going up. That's 100% correct. And the reason I'm going for the heavier side on the call is because DD ratio is square in half and bang on bull side holding. That's it. And because the severity of a sell-off is going to be more severe than the severity of a rally. If we sell, it's going to sell hard. If we rally, it's going to rally minuscule. Right? Market has already priced in the expectations. A rally is going to be very small. So, you nailed it. Yeah, you nailed it. So, what are you... So, Arsh, you're doing... You have a credit put spread on SPY. Not losing much theta as much as like $1.48 theta on the short leg. What's your expiration on your credit spread? And never, ever, ever, ever don't go in there and start 0-day. Don't be buying 0-day options unless you're day trading them, especially when IV is high like this. Because once that IV deflates and that theta kicks in at the end of the day, because the Fed is happening at the end of the day, those options will rapidly deflate by the end of the day if the range isn't broken. And the legs, let me talk about like the force, the delta on the calls. It's not 30. And the delta of the puts is about 20. So right, the delta is slightly higher because they're asymmetric, right? The calls are closer to the money than the puts are. And the reason for that is the severity of the bull side, I believe, will be smaller, and the severity of the bear side, I believe, will be bigger. I honestly think that the market is... I'm trying to like get like 2 steps ahead. I think the market's going to pop and then drop and then probably pop again like it did on CPI. Because I feel like the press conference, if they're going to cut rates once, the press conference seems they're going to cut rates again. So I think that like when we talked about earlier, like the newbie trader is like, oh, let me buy the Fed because they raise rates, and then the average trader will do that. The advanced trader will say like, okay, everyone's going to do that, so let me sell the pop. Okay. Then the advanced trader is like, if the Fed's going to cut rates once, they'll probably cut rates again. So betting the bull side. Like if the market's unhappy, it's going to sell so hard that I'll be okay. If the market's mildly appeased in that press conference and he says, yep, we're going to take a more aggressive rate cut, and it's going to fly. So the one thing that'll be kind of damning to this trade is if we get a rate cut of 25 and they go, that's probably the only rate cut we're going to get. You know, maybe we might do one more by the end of the year, maybe not. It doesn't seem so aggressive. And there's going to be a like possibly muted response. There'll be some volatility. It'll ultimately side to the bullishness. But the knee-jerk reaction to the sell-off is a buying opportunity for the next couple of weeks. Monthly maps are strong. Market's bullish. A sell-off will just be a sell-off. And you can see right here, the market is definitely comfortable at the highs. Bull zone decreasing, bear zone decreasing. So the market is solid here. As a matter of fact, it wants to go higher. But, you know, catalyst can change all of that, but we'll see. The reason I bumped my puts out, I'm not buying them on the same expiration because I want my puts to suffer less theta in case I'm wrong. which I'm likely to be wrong because I'm being the blind monkey today betting on the bull side of the market. Yeah, if you got the Zoom call, you'll be able to watch the previous recordings. They're all there in the Discord. Yep. Oh wow, like 8 of you just bought the Zoom call. It's a huge group, massive group in those courses. R said everybody needs to join so I can get him to teach him some option stuff. So the idea is if we break monthly hedge pressure, we all know it's a gamma squeeze. It'll fall really hard if that happens. I don't expect it to happen. I always reverse monthly hedge pressure. So the bet is that the market maintains bullishness. We're so close that if we break this, the severity is massive. So those puts will kick in super duper fast. And I wouldn't have been, you know, I wouldn't. The fact that this breakout range is so close, it's a wound up spring. I mean, that's what it is. This is barely like. On the S&P, it's even worse. It's like so tight. Look at this. The breakout ranges are so tight. That's why I feel safe making bets kind of like this. Look at this. Like the market breakout range, this should scare all of you. The range, breakout range is so thin. Look at this. This is the bull breakup. This is the bear breakdown. Hedge pressures. You guys see that? It's so that's like why I'm betting on volatility. The market's gonna fly. There's no way that we're gonna stay in a 6-point range. What? On the S&P? We're gonna cut rates? 6-point range? Oh hell no. Hell no. IV is close to 70% on these 0-day options. The market's going to be volatile. We're above triple B, baby. There's no way we're going to sit pretty in a 6-point range into the Fed. The probability that my trade fizzles out is practically nothing. Do we all understand this? Everyone in chat, yes? You get this? Everyone in chat, you understand this? No. Well, not just good for options, so no, good for options buyers. The straddle is the winning trade today. Straddle is the winner. You're basically, you can buy a put and buy a call from right here and bet that there's going to be volatility. The side that wins is 200-400% gain. The side that loses just loses everything. You guys get it? Everyone get it? There's no way with rate cuts and disappointment and 50 basis point that we're going to be moving 6 points. Okay, this is ridiculous. Okay, there's going to be volatility today. Oh yes. So, you know, that's part of it. And like I said, come to the Zoom calls. Raising money to develop on the platform, the probabilities that you see that I talk about will be printed on the charts with these legs. That's the next step. The developers are going to hire to build that. They're going to build that for us. So I want everybody here at minimum, if you're a lifetime member, support the drive. Come to the Zoom calls right there. $1 a day. And what that does is we're going to hire 2 new developers to build this out. We're going to build resilience for weekly hedge pressure. blue resilience line at the bottom. We're going to do dynamic hedge pressures on the chart instead of the bot in the Discord. We're going to do what's called AI assist, probabilistic backtest, the probabilities printed on the charts, the game changer you wanted. So we appreciate you guys supporting it. The more people that sign up, the faster we can make it. There's no way that we're not going to break out today. It'd be impossible for the S&P to not move 6 points. The risk interval alone is 37 points. You know what I'm saying? Does everyone get this? 37 point risk interval. Just, it's going to span that distance, likely up or down. Even if it goes nowhere, it's likely to span that distance. And by spanning that distance, it's going to break one side or the other. You know what I mean? Baby, I'm going to teach you guys everything I need, everything I know about options. I will. This course series is not like anything you guys have taken before. All it goes over is the stats and odds of just the trades I take and why I take them. The exit strategy on this trade is how I'm going to make money. So you guys, if you're on the Zoom call today, I'll be exiting it live. You all can watch. That's the one part I'm leaving out. It's a trick. How many times do I want a long monthly hedge pressure today? I'm going to sit out on this one today. Although resilience is good, I should probably scalp it long one more time to maybe go back to bull zone. Let me just put 2 contracts on it. I love this. I love these scalps. All right, I'll be right back. Bathroom break. Yeah, we're breaking in some direction for sure. Oh god, I didn't mute the mic. Well, I hope you guys got a good soundbite of me taking a leak. Are you good in here? Oh, my mic was pretty good at not picking that up. Good. Oh yeah. Market's gonna fly today. Is going to fly today. But make sure you guys understand that on Discord. Did y'all know that? That 70% of months are green and 30% months are red? And of those 30% of months, 60% of them recover a third by the end of the month. How crazy. Oops, shit. What am I doing here? Click that button. Windows button. All right, let me click this button. Market's trading lower to anticipate the pop. That's why it's trading lower right now. To negate some of that volatility. Causing a major breakout because the market's wound up so tight. If I were selling off now, it's just sliding lower to bet on a pop so that the pop doesn't create such a major squeeze, right? Because the gamma squeeze range on weeklies. No. Market's gonna move today. Yep, we're gonna span a big range today. Yeah, market's gonna move today. Even if muted, it's gonna move. That's the thing. Even if muted, even if it's a non-response, like a no, even if it's a no, like the market goes absolutely nowhere. Unless the premature selling is indicating that there's inside information leak that there will be no rate cut. Wall Street will be very disappointed in hearing that. The market will just sell pretty hard. Maybe just for the day. All right, MHP on Qs right now. Finally, the first tap on MHP. All right, let's add to that. So what did I tell you today that my loss would be? Do you guys remember paying attention? What my you guys remember what I told you my overall loss would be? You guys remember? Roughly that. About 600 bucks. Oh no, 180 times 2. So about 700, give or take. The market goes nowhere. How much you gonna lose on theta? $400 on this one. That's after a day. My bad. Let me start over. And then roughly 20 bucks. So roughly $200 on this one. Yeah, close to about $700. Right. Oh, MHP testing on a break. Nasdaq. Why the premature pricing down is just to prepare for a pop in the Fed. Yeah, that roughly inside, just like goofing around in this range, I'll be down less than 1,000, right? And so now that we're goofing around in the range, if those puts start, here it is, right? Down $400. Actually, like 400, 450, $500. So that's it. This is the range where if we don't move, the puts haven't kicked in enough to offset the calls. So that's basically it, right? It's just balanced here. But if we do crash MHP and start to sell really hard, then that's just gonna, the deficit's gonna be even closed out bigger. So we had that bear zone and keep falling in Qs. That's it. So I want the market to move. That's it. All right, we'll be back. It's time to get out of here, but we will be back. FOMC, everybody join the Zoom call. You will learn everything I know for $20. For $20 a month. Support that. Support us. Our drive to hire some more developers to give you better, cool tools. Everybody, lifetime members, we ask that you also donate. This will be helpful to us to grow. We love you to death. We'll be back. Promise. Come later in the day. We'll be on Zoom.